Hello, my name is Trevor Noren, Investment Communications Strategist at Wellington. For 40 years, Future Themes has been instrumental in shaping the firm's investment strategy. The question at the heart of the initiative has always been a constant. What are the structural trend lines that will shape markets, societies, and economies over the next 5 to 10 years? Future Themes leverages the firm's breadth of expertise to find answers and deliver actionable investment insight. The research is done, and now it's time to present. We kicked off last week with a sit-down with Dara Dunn, the leader of this iteration of Future Themes. He and I discussed the architecture of the effort, how ideas were sourced, how research teams were organized, and the key top-line insights from each of our 4 areas of focus. The 4 S's: sustainability, systems, society, and science. Today, we kick off our deep dive discussions, drilling down on our first S, sustainability. The escalation of climate change is one of the clear inevitabilities of the next decade. What will it mean for migration? What will it mean for water scarcity? And how will it force Wellington's investment strategy to evolve? They are questions not only vital to the future of our firm, but to the world. And we've brought together an incredible collection of experts to debate. So now I'll turn it over to the team.
Thank you, Trevor. My name is Bob Sharma, and I'm a relationship manager in London. I'm very pleased to introduce our 2 speakers for this Future Themes session on climate migration. We have Chris Melendez, who was one of the research captains for this topic, and he's a credit analyst with over 20 years of experience. We also have Tarak Rao Chakravarti, who's a contrarian investor on the equity side. So let's get started. Now, there's been a lot of interest in climate change right now, with many clients focusing on the transition to a carbon neutral economy, or indeed physical risks associated with climate change. Chris, can you tell us why we chose climate migration as a research topic?
Sure. Thanks for having us, Bob. There were 3 main reasons why we chose this topic. First of all, there was a high level of firm interest. There were over 30 entries to the Future Themes project, specifically on climate migration. So high interest was the first one. Secondly is that we felt that this was an underappreciated topic from an investment perspective. We thought that we could differentiate ourselves as a firm, given our relationship with our external climate migration consultant, and we thought that it was an environment rich with ideas. Lastly, it's a global issue. Climate migration is far-reaching, it has far-reaching implications, and it will impact geopolitical instability. And for that, we thought that that was another reason why we picked this topic.
Just a quick follow-up question there, Chris. Can you talk a little bit about how we organize and approach this research?
Sure. The first thing that Camp Goodman and I had to do is pick a team. And that was one of the most rewarding parts of this process for us, is that we could go to anybody in the firm and ask them to help us with this project. And we did just that. We picked a diverse group of individuals with all areas of skill set in different parts of the firm. We had, an equity analyst, a muni analyst, somebody from investment science, a macro analyst, and a sovereign analyst, and all of that was what made us have success, is having a great team. Secondly, is that we didn't question whether climate migration would occur. We just assumed that it's going to happen and that it's inevitable. So we didn't spend a lot of time backing that up. We just made that assumption. Thirdly, is that we had a North Star, and that North Star is that we wanted to produce concrete investment recommendations that were executable. So we didn't want this to be a theoretical exercise. We wanted this to produce results. And we did that by developing 5 key themes associated with climate migration. And then we used those 5 key themes as jumping off points to determine actual recommendations. That was our process.
Great, thanks, Chris. Now, as you conducted this research, I know you talk about these 5 key themes or foundational truths that you uncovered along the way. Tarak, maybe you can talk a little bit about what those foundational truths are.
Great, thanks, Bob, and thanks for having us here today. So the first key theme that we uncovered was what drives climate migration. And when we think of climate change, we tend to think of big one-off events, whether it's a hurricane or a major flood. And while these can lead to temporary displacements, the research actually indicates that larger drivers of migration tend to be permanent changes in livability. So that's permanent increases in variables like sea level or temperature. And that's what leads to permanent migration. And we actually see interesting patterns across the income spectrum. So migration tends to be lowest at both ends of the income spectrum. At the high end, those with the resources to adapt can stay in place and adapt to higher temperatures through AC their jobs are more secure. At the low end of the income spectrum, people lack the resources to move and they tend to stay in place despite a worsening climate. The second foundational truth that we had was that when people do move, they tend to stay close to home. So we think of migration as crossing borders, but the UN estimates that up to 80% of all migration is actually internal to countries. And then the third foundational truth that we found was that as people move due to climate, they're likely to move to large cities. And there's both a push and pull aspect to this. The push factors are that in their home regions, you can see things like reduced agricultural yields and a lower perceived future income. That pushes people to seek out new opportunities in cities. Cities then have pull factors. That higher prospects for jobs and employment, as well as education, and they're natural economies of scale in cities that make them increasingly attractive to migrants. So again, we're thinking about permanent changes in livability that drive migration. When people migrate, they stay close to home, and then they tend to migrate to cities over rural areas. And the fourth foundational truth that we found is, where is this happening? It's typically 30 degrees north and south of the equator in what's called the horse latitudes. And climate models indicate that this is where we'll see the largest future temperature increases. And to kind of conceptualize that on a map, in Africa, it's the area from the Sahara Desert to the Kalahari Desert. In the Americas, it's both Latin and Central America, as far as north as Mexico. And in Asia, it's much of South and Southeast Asia that falls into that horse latitude bands. And finally, as you might expect, climate migration has very significant implications for geopolitical instability. For years, the national security community has described climate change as a threat multiplier, and migration falls directly into that classification. Migration places additional stress and just accelerates underlying tensions in countries, whether it's social divisions or increased financial burden on vulnerable governments. So this increases the risk of cascading failures from a geopolitical level. So those were the five foundational themes that we found in our research.
Thanks, Tara. Some really fascinating themes there. Chris, perhaps you can build on some of those foundational truths and outline what some of the high-level investment implications are.
Yeah, I think first is the point that Tarat made with regard to 30 degrees north and south of the equator is very important, and that is definitely a high-level investment implication for us, is that the countries within that region are going to be most impacted, and a lot of those countries tend to be emerging market countries. So we had a lot of interest from our internal emerging market investors with regard to this topic. And I think secondly is another high-level implication is that we feel that climate migration within countries and is not going to impact the country entirely the same. We think that there'll be more granular implications within countries and that it's going to be more of a micro type impact than a macro type impact. And so you can't generalize the impact of migration for an entire region or for an entire country. You need to look at the micro level. And I think that those 2 points were high level investment implications for us.
Yeah, I wonder if we can spend a bit longer at the micro level. Some really interesting high level observations. Tarek, maybe you can drill down into some sector specific takeaways for us.
Absolutely. So, if we think about the most granular and immediate act that people may take when they migrate, it's often payments and remittances. And we think that migration has big implications across the broader payments ecosystem. So, say it's a primary breadwinner moving to a city, leaving behind spouses and children in the rural villages. They'll need to send money home to support the family from their job in the urban center. So most immediately, this impacts payment and remittance providers. But then, as Chris mentioned, within emerging markets, this has big implications, and that's where we see a broader ecosystem of providers emerging, particularly in the telecom industry. So many emerging markets telecoms have started to roll out mobile money platforms. In some areas, this is one of the primary products that they offer, with mobile money penetration over 90% in some countries. And in other areas, mobile money is actually a nascent but fast growing part of the business. And what we see in those telecoms is they may be the most popular telecom in a country, but then actually, if you go down to the refugee level, they're even the most popular telecom within a certain refugee population. And so I think the broader payments ecosystem really stands to have major shifts based on climate migration.
Yeah, and Bob, I think another sector that is really interesting that will create investment opportunities is mitigation. Anything associated with mitigation is going to be impacted by climate migration. And I'll give a few examples of that. First of all, the electric utility sector is highly involved in this mitigation process. And this is something that's near and dear to my heart, covering the utility sector. In the US, you need to see these utilities plan for this climate migration, and that's companies increasing load, and some companies planning for decreasing load. There's a lot of mitigation that's required as a result of storm hardening. We have specific companies that spend time for storm hardening and increasing this resiliency of the grid that we found as good investments. So the electric utility sector with regard to mitigation is front and center in this process. Another example would be AC air conditioning manufacturers and installation systems. And this isn't earth shattering or groundbreaking, but we do feel that it's an important area where there will be some investment ideas.
Are there any other examples that you wanted to highlight?
Bob, I think we talked a little bit earlier about urbanization growing as a foundational truth, and there are implications for this across investment sectors. It starts in the basic materials as natural resources are needed to build new infrastructure in cities, and then it flows through to housing and associated finance. As well as mobility within larger cities. Does that mean that people need to find new forms of transportation? Do governments need to invest in larger public transit infrastructure? So overall, I think urbanization presents just a wide array of investment opportunities. So the move to larger cities as climate migrants enter into new countries or new areas of their own country is definitely something to watch.
Thank you both. Some really interesting insights there, so appreciate that. Now, maybe switching gears a little bit, now that we've had a chance to discuss some of this research with other colleagues and investors at Wellington, as well as a handful of clients, I wondered, are there other areas that you'd like to spend time on? Other areas of further research that you think might be warranted?
We presented a lot of these findings to clients, and one interesting thing that they brought up was demographics and how demographics will come into play with regard to climate migration. Will women be more or less impacted? Will children be more or less impacted? And that's not something that we spent enough time on that I think we'd like to do more work on. Secondly, we looked into the benefits of host regions. How are they impacted by climate migration? Is there a long-term benefit to a region that accepts climate migrants? And there's not a lot of data on that. It was difficult to support. And we'd like to dig into that more because we think that could be interesting, because I think most people feel that the host country is negatively impacted over the short term, but over the long term, it could end up being a positive. And we'd like to substantiate that more. And then lastly, we debated the concept of, will future migratory paths be similar to migration paths that that currently exist or existed in the past. And we think that climate migration paths will change, but we need to do more work on that because there's some support that says, look, climate migration paths are well established and will maintain the existing location. But we do think there could be changes, and if there are changes, that will have investment implications. So we need to spend more time on that also.
Yeah, okay, interesting. And what about areas of pushback, Tara? As we've discussed these ideas with other investors, were there areas where you felt there was some pushback on some of the ideas?
Yeah, sure, Bob. Of course, anytime you've inside the morning meeting room, you're going to have a good amount of debate, and I think this was no different. What I would say is that we tended to see the main pushback come on the sense of duration and when exactly climate migration might play into a given investor's process. And by and large, I would say that our fixed income colleagues tended to view this as a more immediate input into their process. In particular, sovereign and EM analysts on the credit side said that this migration issue is something that they're seeing in their coverage right now, and they're paying attention to right now. Conversely, on the equity side, I think it varies really by investment philosophy and product and the time horizon that investors are looking at. But pretty much everyone agreed that migration is going to play a role. It's just kind of a question of when. And is this more a nascent part of a business that someone's looking at, or is it already a fairly real impact? So I think that there's a healthy amount of pushback, but everyone agrees that it's a serious issue.
Thank you for that, and thank you both for your insights. Really enjoyed talking to you both, and appreciate you taking the time. I guess in closing, as the effects of climate change continue to play out, I think it's important for our clients and investors to take into consideration some of the perhaps underappreciated impacts, such as climate migration. So thank you both for shining a light on this linkage. I'll now hand over to Chris Goolgasian, who's going to discuss another topic that we covered within our sustainability stream, and that is the topic of water scarcity. Chris, over to you.
Thanks, Bob. I'm Chris Goolgasian, Director of Climate Research at Wellington, and I'm joined by one of my favorite people, Tim Casaletto, who's an analyst covering European utilities, airports, and toll roads. And today we're going to talk about water scarcity, one of our key future themes for the capital markets. So I'm going to make some opening comments on our key findings, and then we're going to talk about the application to Tim's coverage. So the first thing I would say is that, the phrase, this time it's different, is often untrue, but this time it really is. And the reason it's different is that the projection accuracy on water scarcity and drought has improved quite a bit in the last decade from the science community. We have a much better read on things, and unfortunately, things are getting far worse at a rapid pace, to the point where even in just the 2030s, we may start to see some significant issues. One of the major findings of our research work with the Woodwell Climate Research Center is that the variability of precipitation is going to increase dramatically. In just common terms, one way to think about it is a great quote from a book that we often show to people called The Ministry for the Future, really well done about climate change in the future. And the line in there is, it's often too much or not enough. And that is what we're going to see with precipitation, too much or not enough. And what that leads to is this oddity of we have more droughts and more floods. It's a really strange thing. And the reason for that is the precipitation is compressed into smaller periods where you get a lot more volume, and then longer periods where you have drought. And so this variability has changed a lot, and it's going to lead to more droughts, to more water scarcity issues. And that is one of the reasons why this time it's different. The other reason why it's different is that population growth continues, and that in a climate change world exacerbates the problem. So one statistic for you is that in the last 100 years, the global population of the world has increased about 4 times. but the water demand has increased about 6 times. And the lesson there is that as people rise up the middle class, the water usage goes way up, and that's a problem that perpetuates itself. So, when we think about investors and markets, one thing that appears to us that's going to happen is you're going to have this circle, and the circle is something like water footprinting, akin to carbon footprinting, will really take off at the company level. It will be required disclosure. Stakeholders will expect it. And once it's disclosed, there will be a lot more eyeballs on the water efficiency of companies. And even social change like shaming could become an issue where once you're aware of how much water a company uses, you become much more attuned to whether it's being used efficiently. And this is not just industries like beverages and energy, but I think increasingly there'll be a lot more focus on areas like semiconductors, which are massive users of water. So with that, I'm going to turn to Tim. And Tim, one of my favorite quotes is Charlie Munger, invert, always invert. And one of the things we did together was invert the water findings and think, well, what may not be true as opposed to what is true. And I think one of the surprises for people may be that water utilities are not actually the best exposure to a water scarcity theme.
Yeah, Chris, thanks. I think that's right. Maybe it might be helpful if I just talk about my investment framework for investing in utilities and the qualities that I look for, just really as part of my fundamental investment framework. And there are really four key traits here. So I'll discuss these four traits and then also maybe just talk a little bit about how I think these water utilities and the topic of water scarcity fits into these traits. So the first trait here is when investing in utilities, you want to have aligned interest between the utility and the regulators and the governments. So keep in mind that utilities are regulated monopolies. So effectively, the happier the regulator, the easier it is for the utility to operate their business. If we apply this to water utilities, they're great. There's very clear alignment between the water utilities, the regulator, and the government. That is that we all want to avoid water issues. So everybody is on the same page from that regard. If we go to the next trait that I look for in utilities, it's a growing asset base. So if you think about the utility business model, effectively, the more a utility invests, the higher their asset base. And the higher their asset base, the higher their earnings. It's really as simple as that. And so if we apply this trait of a growing asset base to water utilities, again, they screen really well. If there's investment in more infrastructure to avoid water scarcity, that leads to higher growth for the utilities. So, water scarcity is good for the water utilities in this regard. The third trait that I look for when analyzing utilities is the quality of their service. And so when the quality of service at a utility is high, that keeps the customers happy, which is great. You want happy customers in any business. Conversely, when the quality of service is low, customers become unhappy, and then they tend to complain to the regulators, who are typically elected officials. So of course, the regulators will do anything in their power to make sure that customers are happy, and that will come at the expense of the utility. So you really want to keep customers happy because happy customers equals happy regulators, which is good for the utility. So with that out of the way, how does this apply to water utilities and those that may be facing water scarcity? It's actually a really big negative because if we have water scarcity issues, it's almost certain that the water utilities will be blamed for the problem. And when that happens, that introduces reputational risk to the utility and also likely negative consequences from the regulator. This can be financial penalties, it can be lower future regulated returns. It can be more difficult for the utility to get their future investment plans approved. So here's where water scarcity becomes a problem for the water utilities. The last quality I look for when investing in utilities is low customer bills. And this is even more true when operating in non-affluent service territories and also in emerging markets. And here again is where we run into problems for water utilities that are facing water scarcity issues. Effectively, the more you invest in the water infrastructure, the higher the customer bills become. And when people aren't happy, if the customer bills go up, they complain to the regulators and to the politicians, and then the politicians again make the water utilities' life more difficult. So if we pull all this together and just think through my investment framework of to answer the question, would we want to own a water utility in a water scarce region? It can be tough because on the one hand, with water scarcity issues, the utility will invest capital, and if they're too proactive when investing this capital, that will be viewed as really wasting capital at the expense of having higher customer bills. Uh, then again, if the company is not proactive enough, they will be blamed for the water scarcity issues if they do materialize, and then they become villainized. So I guess pulling this all together, if I knew for certain that an area was more likely to have a water scarcity issue, based on the fundamental framework that I just laid out, I would not want to invest client capital into that stock. And I just don't think that the water utilities are really positively exposed to this theme of water scarcity. So that's what I would say to that, Chris.
Yeah, Tim, I think, what confounded me when you shared that idea is, we do look at what goes on in the industry. There's lots of water related funds and strategies and sustainability themed funds and strategies. And a lot of them own some of the traditional water based utilities. And, I didn't quite understand if what we think is the case. So why do these strategies tend to own these as plays on the theme? And any take on that?
Yeah, I think it's a great question, Chris. I think it's counterintuitive to think that water utilities would not be the way to invest in water scarcity, and I think that's really why some of these funds, own these water utilities, is because it's just natural to think that a water utility will benefit from water scarcity. But again, I think that's a misconception here because, as I said, if that utility does run into water scarcity issues, they will be blamed for them. And we saw a case, I believe it was in 2019 in Chile, where there was a water utility that suffered from a drought that year, which led to issues for customers. And that was a very bad stock while they were going through that. So I think the reason that others own it is just because of the counterintuitive nature of everything I laid out. But I do think it's a misconception that water utilities are the way to invest in water scarcity.
Yeah, and then I think you kind of touched on the other thing to think about is the reputational risk and the outcry from the consumer. And we actually just witnessed just a few months back a live event in Texas where a lot of pressure was put on the utilities, not for water necessarily, but for other energy sources. And did you take away any lessons from that, Tim?
Yeah, really the Texas situation, it was an embarrassment for the government, for the state government, the local government, and for regulators. And I can tell you one thing, that the utilities in Texas, they got blamed for this. Why weren't the wind turbines? Why did they not have de-icing technology? Why could we not get proper gas to these gas power plants to keep the lights on? So, again, I think a lot of these companies were blamed for being part of the problem that they faced. Now, let's take this Texas example, because there actually were some water scarcity issues in Texas, during this period. Now, the water utilities in Texas are not publicly listed, but if they were, would you want to own these stocks, during this issue? Absolutely not. The Texas water utilities, they were the punching bags for the regulators with the water issues. And if you don't believe me on that, you can just check some of the Texas water utility Twitter accounts during this period when that was happening. And you can just take my word for it. The customers were not very happy on Twitter when they had to go days without clean water. So yeah, I think there is an indirect parallel to the Texas situation, where it wasn't directly water scarcity, but it was a shortage of power. And it's just the infrastructure companies just do not benefit in a scenario like that in the short to medium term.
Got it. Great insights, Tim. Well, before we go, I just want to leave everyone with one final thought, which is, in the sustainability landscape and the climate change landscape, we're often thinking about multiple decades out and how to reduce our emission footprint. And some of that almost seems devoid of the humanitarian view. But the fact is, we may have humanitarian crises before we address all of our carbon issues, and that could be something driven by water scarcity. So I think that the markets may be surprised that our eyeballs are on one thing, which is carbon footprint, but we may have some type of, hopefully not, but some type of global event around drought or water scarcity that really wakes people up to the fact that some of these physical risks are here long before our ability to solve the carbon emission issue. With that, I want to thank Tim for his insights today. We really appreciate it. And thanks, everyone. Hello, everyone. I'm Chris Goolgasian, and today we're going to talk about climate research and how we integrate it into the investment process at Wellington. I'm joined by three colleagues who I really think are at the cutting edge of this field in the industry, and they're going to talk about their asset classes and how they integrate our work. But just by way of background, we started our climate research about 3 years ago through a partnership with Woodwell Climate Research Center. And that work was really to focus on key physical risks of climate change, things like heat and drought, wildfire, flooding, water scarcity, hurricanes, and how they actually may impact not only society, but the capital markets and the securities we invest in. So we will talk about more of that today. Now, what's interesting is every 7 to 8 years or so, Wellington does something called Future Themes, where we try to look out into decades of what might happen. But today, a lot of the decadal events of climate change are already with us. You're seeing items like record wildfires and record hurricanes. So even though some of these items are into the future, some of them are happening right now. And one of the ways that we analyze that is through a proprietary technology that we designed called CERA, C-E-R-A, which stands for the Climate Exposure Risk Application. And through this tool, we are able to project climate risks out into the next 3 decades on any geographic location in the world, and then intersect securities or markets that we might think could be impacted through that climate risk. And that tool has been helpful to investors as they size up the risks and opportunities for their portfolios. So let's think about how this is all applied. Alan, you've been really with us from the get-go in terms of integrating climate change into your process. How do you think about the risks from your portfolio perspective?
Sure, Chris. Well, I think everyone can have their own definition of climate risk. I tend to think about climate risk as the intersection of where you have some climate-driven physical pressure that meets with the lack of resilience or preparation. And I feel as though almost every major episode we've seen of late that we can tie to climate exhibits those two qualities. And an important component of this is that these types of pressures seem to be recurring, and yet the lack of preparation really hasn't changed. I think of the most common examples, perhaps the ones that are the most relatable, are these natural disasters we've seen. You've had a lot of examples of those recently, including the California wildfires, the bushfires in Australia, the severe flooding and hurricanes that we saw in Houston over the past couple of years. I think one of the dangers of these episodes is that they typically are viewed as one-offs, and yet each of these were statistically significant in their own right and also exhibited trending features in that there was some degree of reoccurrence over the past several years. But again, in each of these cases, it wasn't just the natural disaster itself. It wasn't just the weather. It was the fact that oftentimes the physical environment or infrastructures that were impacted weren't built for resilience, and as a result, were much more vulnerable. Beyond natural disasters, you also see perhaps less appreciated examples. For instance, you can see where changes in climate can greatly impact agriculture. I recall one of the last Woodwell meetings, Chris, that you hosted on behalf of Wellington, and our discussions with the Woodwell team relating to how changes in the Brazilian rainforest, as an example, was impacting agricultural productivity. And this makes sense and is a problem that likely gets worse because so much of today's agriculture is developed along the equator, which, based on Woodwell research and our own tools, would suggest is an area of the world that becomes less agriculturally productive over time. And you can see visible deterioration of critical inputs related to water in particular, but also deterioration in the conditions under which things like seeds or pesticides can even be productive. And then even beyond this, you see some adverse impacts, even in really surprising areas. I recall last year we've had discussions with the Woodwell team about how even the production of renewables themselves can be adversely impacted by climate. We know from speaking with some of our companies that build wind farms, for instance, that wind conditions over the past couple of years in North America have been much less productive, much less available than previously. And this is meaningful to companies that may use a moderate amount of leverage to support or finance their asset base. We've seen where reductions in hydrology in parts of the world that depend on water abundance, there's a myriad of different ways to think about climate risk that extend beyond just the occasional headline-grabbing natural disaster. And I think over time, more people will come to appreciate some of these.
Alan, thanks for that. And you talked about livability, which obviously has a lot of ramifications for real estate municipalities. Jessica, I know your team has done a terrific amount of work on municipalities and attractiveness and climate risk. Could you tell us how you guys think about risk at the muni level?
Sure. So, unlike most corporate investments, muni bonds are tied to a specific location, and that makes it really important for us to understand the physical risk to a municipality. They can't be moved. A company can move its headquarters, might be able to move its stores, but a municipality will always be in that one place. It also makes it possible for us to look at the aggregate risk across a portfolio, making sure that a portfolio doesn't have too much climate risk in one specific area and that they're geographically diverse. In addition, our bonds are often long dated and can be pretty illiquid. So we have to understand the long-term physical risk to our credit to understand a credit's risk profile and whether it's an attractive investment. There are a lot of climate risk that municipalities and municipal bonds more broadly can face. First, municipalities might have to take on more debt to mitigate climate risk and also repair damage from severe weather events. And that could increase their leverage, potentially decreasing a city or a state or a county's credit rating in the long term. At the same time, the tax base could face pressure if we see outmigration from either severe weather events or other climate change factors that cause outmigration. Or also if we see lower property tax values, that decreases the tax base. And that paired with increased leverage can really cause negative credit outcomes in the long term. In addition to looking at your typical city, state, tax-backed muni bond, we also take climate change into account when looking at revenue bonds, like hospitals or senior living centers. Those are very much single-site assets often. And they can face stress from severe weather events that hit them, from longer-term outmigration risk in their metro area, and especially from property damage that occurs during the construction period of those bonds, causing revenue disruption or potential increased costs from construction. So we, using the CIRA tool, we map our holdings across portfolios and dig into the climate risk factors that affect individual bonds in our portfolio, especially for our longer dated assets that aren't supported by other credit support mechanisms.
Yeah, we often talk about fixed location and long maturity as the highest vector of risk, which clearly a 30-year uni bond has, but real estate has an infinite maturity, if you will. So Bradford, you've been super thoughtful throughout the years on climate, I think very early in your asset class. Could you share how you guys think about the risk side of the equation?
So property are long duration assets, and the majority of the value of these assets is tied to terminal values. And those terminal values are impacted by the trajectory of rents, which is determined by underlying demand for those assets, and the volatility of those rents over time. What could change that trajectory of rents, other than be it traditional demand or exogenous factors such as climate change. So with this in mind, it's important to understand these potential tail risks that could impact longer term terminal values. And one way we seek to accomplish this is through a thorough analysis of the company's underlying company's holdings and the potential risks to their portfolio, either on the first derivative, which would be physical risk to the asset, or second derivative risk from climate change, such as some of the areas that Jessica and Alan highlighted, be it taxes, fiscal health, etc. So when we dive into this, we examine, using the CIRA tool, a company's portfolios, going through these various risks. First, we look at the potential liabilities associated with physical risk. That is, asset location matters. How an asset may be impacted by hurricane, flood, fire, etc. Second, we spend a lot of time understanding changes in the insurance markets and how these various insurance markets are dealing with this physical risk over time, and a company's ability to insure their assets will impact asset values. Third, we look at the fiscal health of a geography, similar to what Jessica does, because a region's ability to adjust to physical risk will impact demographic trends over time. And then as a part of that, what is the changes to local tax structure? Do geographies need to raise taxes to improve their infrastructure to combat climate change over time? And then finally, demographic shifts that can be impacted by climate change, either because a location is less habitable, as Alan mentioned, or because taxes have gone up, insurance prices have gone up, or there's greater physical risk to an asset that causes less demand for those assets and therefore less rents and lower property values over time.
Thanks, Bradford. I think maybe we'll move from risk for a moment. We started with risk in this project, 3 years back, and investors are always looking for both sides of the equation. So there are risks, but there may also be solutions, opportunities, adaptation ideas. And I think what occurred to all of us is that the spending needed for resilience, for adaptation, is enormous. From almost any study we read on one of these risks, it usually starts with a T, as in trillions. And unfortunately, most of this is somewhat baked in and coming. And so we're talking about, can society adapt to heat or to more wildfires or to more flooding or to more hurricanes? And so I'll just take a moment before I ask you to come back, Bradford, and talk about the other side of the T account here. But from my perspective, we have found a number of companies that I would frame as they're going to help society adapt to climate change. And these are areas that would occur within, say, dredging, or within wildfire. You might need more generators for backup power, or water efficiency as we have more droughts, or impact resistant glass as you have more hurricanes, working on condos and houses and the safety of their structure. And so there are actually a number of companies who are positioned to offer products that's going to help society adapt to all of these risks. And that's within the traditional equity space. But there may also be solutions and opportunities in real estate, munis, and alternative energy as well. So Bradford, maybe you could take us through, how do you think about both sides of the ledger?
What we do is we really step back and analyze each individual company to understand what is the underlying risk, the underlying climate change risk to that company's portfolio. What is the time frame of that risk when it could happen and impact the company's portfolio? And importantly, is it priced into asset values at this time or not? And that last point is really key, because ultimately we want to invest in companies where this risk is fully discounted or sufficiently discounted into the security's price relative to other risks out there. So how do we do this? We seek to do this by using the SEER model, as I mentioned, and really diving into the various components I talked about, understanding the exact physical risk per location, understanding, is insurance premiums going up? Is that priced in? The fiscal health of a given market and the ability of that geography to bounce back, tax regimes, and of course, longer term demographics. I think, as you highlighted, that there's an ability or a willingness of society to adjust over time, but it's really the question is, what is the cost to that? And is it reflected in the long-term growth trajectory of these companies? The second key element goes beyond just analyzing the companies and the trajectory of their potential portfolios and asset values of their portfolios. It's also really engaging with companies to help them better understand the underlying risks to their portfolios and how they can mitigate these risks over time. And really, this is our best tool, is engagement with the companies, because ultimately, if they better understand their risks, then they can deal with them and build a more diversified portfolio over time. Can't take the real estate with you, you can't move it. So their ability to diversify their portfolio to geographies that mitigate some of these risks are ultimately the best tool for those companies, and ultimately it's the best tool for us. Where we are not successful with engagement, ultimately, that can result in a sale of a security.
And Jessica, once again, I can't overlook the overlap between real estate investing and munis. How do you think about this? Is it just as easy as, well, we know the risks are in these cities, so as Charlie Munger says, invert, always invert. So let's find the ones that don't have the climate risk and they're more attractive. One assumes it's not that easy. How do you guys think about it?
No, I mean, that's certainly part of it. Ideally, all else being equal, we'd prefer to invest in a place with less climate risk than a place with more climate risk. And step one is to identify the metro areas that are most affected by climate risk. But in addition, we want to find the places that have the resources to mitigate risky outcomes if necessary. And usually that means having a larger, wealthier tax base. So, for example, New York City is susceptible both to hurricane risk and also to sea level rise and other severe weather events. However, New York City's tax base is so huge that from a credit perspective, even relatively large infrastructure projects won't have a material impact on the credit profile from our perspective. So we look for areas that can mitigate that risk. We also look to invest in areas that don't have as much climate risk. But also, like Bradford, we try to engage with issuers to encourage early mitigation efforts and also to understand what they're doing. We sometimes don't have the same power as bondholders have than that shareholders have, but coming as a cohesive voice to the management of a city, for example, especially a city in a riskier area, saying that early mitigation efforts could be a positive from a credit perspective, even if that means a little bit more debt right now, can make a change. We also engage with them to encourage better disclosure, for example, for water sewer systems, showing areas that could be affected by climate change risk or water scarcity. Also, we engage with our hospital issuers, asking them what are they doing to mitigate the risk of severe weather events and learn about the steps that they've already taken. Often they point us to publicly available reports like city climate reports that most muni bond investors don't read, which has been really helpful. The one other opportunity that we look for is also to identify credits in risky areas, but have other forms of credit support like bond insurance, a state guarantee, a short maturity, ample cash, and also otherwise good security. And on the other side, identify bonds from a risk perspective that don't have the best security. For example, bonds where the tax collections could be interrupted because of a severe weather event and the security doesn't protect us.
Great, thanks, Jess. And Alan, I know from our work together, I for one have learned a lot from you about technologies and wind and solar productivity. Can you just maybe share a couple of examples of how you think about where the money will be spent and what the opportunities in the equity space might be?
Sure. So we continue to believe that the energy transition that seems to increasingly be underway is one of the largest mega-decadal or multi-decadal mega opportunities that we will see in our careers, if only because you are completely reconfiguring both the source of the power that is being produced, as well as in many cases, the delivery mechanisms. And that implies significant amounts of capital in order to rejigger, replace, upgrade, in some cases, remove existing, and to replace entirely anew new forms of delivery and power. So we think that, broadly speaking, all forms of clean tech and renewables remain promising areas. Not necessarily every company, but those themes we think are going to be very robust. And one of the thoughts that we've been entertaining of late is the idea that in many cases, adaptation or mitigation is adaptation. So mitigation is adaptation in part, not in whole. So in addition to many of the solutions and the companies involved in those solutions, Chris, that you've mentioned and that you've been focused on, if you think about any company or opportunity that drives more efficiency of energy or water use, adaptation helps to get solved in the process. If you can deliver, as another example, alternative forms of energy, both the source and the delivery, you create more resilient energy infrastructure. So we can often think of mitigation as adaptation in part, but also mitigation with adaptation in mind. So increasingly, when we speak with our companies that are investing in renewables and building more renewable assets, they're thinking about the degree to which the grid is hardened or resilient, because renewables have to tie into the electric network, the electricity network, and that requires a certain level of stability. We are also seeing increasingly that solar is coming with backup storage. That is a built-in form of resilience. We see that wind companies increasingly are thinking about how to add battery capabilities to every installation so that you have a way to extend capacity factors, but also to build in more redundancy. We see companies that are investing significantly in developing EV charging infrastructure. All of these are ways of developing redundancy, developing more resilient infrastructure. And we're also seeing companies increasingly incorporate climate analysis into their own process. They're thinking about the locations of where they're building solar, the locations of where they're building wind, and taking into account future climate conditions as they factor in the productivity of those assets for the long term. And I think people would be surprised at how durable this makes the mitigation opportunity because of adaptation and the way that that's being incorporated into the process.
And Alan, why don't you keep the mic? I think we're going to share some visuals that each of you have. So if you want to take it from there and share with our viewers the following chart.
You can see here, and I'll keep this one relatively simple. This is showing the estimated cumulative investment in new forms of energy capacity over basically the last 2 years, and this is global. So this is cumulative investment in new energy capacity last 2 years. And what you can see is that if you were to tally the renewables, solar, wind, hydro, anything non-carbon, non-CO2 emitting, that is the vast majority. And so in a little bit of a twist, what we have previously referred to as alternative energy is now conventional energy. And the forms of energy which were hydrocarbon-based that we referred to as conventional energy is increasingly alternative energy. And we think that this chart will be the pattern going forward.
Great stuff. Jess, how about on the muni side?
Thanks, Chris. So as you can see from this map here, the northeastern U.S. has a good deal less hurricane risk than South Florida and the Gulf Coast, which isn't too surprising. But what's interesting about this map is you can see at the same time, a bond issued in South Florida isn't pricing in any additional bond premium compared to a bond issued in Ohio, which has very limited hurricane risk. I went through some recent taxable muni new issues, looked at 2 local government bonds that were issued around the same time with the same AA rating from S&P and Moody's, same maturity. And the bond in South Florida actually was a little bit tighter than the equivalent bond in the same sector issued around the same time in Ohio. We look at hurricane risk throughout our portfolio, and this map shows the hurricane risk for every zip code on the eastern U.S., projecting out hurricane rain over the next 30 years.
And Bradford, on the real estate side, you want to share with our viewers a visual as to how you look at things?
This chart that you see, this is a map that shows flood risk in Houston with every REIT asset is mapped on this. And specifically what we're showing is the risk of a 500-year flood event using the Cirrus data in our model. What we do is, this is just one example. We're modeling all climate risk factors for across REIT portfolios. But there's 2 key elements to this. One, it's showing exactly what the physical risk or potential physical risk to an asset is, but also by mapping the climate change risk and then overlaying it with potential changes in infrastructure, we can see which assets over time more susceptible to climate change and which may actually be less susceptible to climate change in a given region based on infrastructure improvements that given municipalities are making.
And Bradford, maybe we could just stay with you. We're going to do a quick, maybe 1 minute round robin for each investor on, what's your take today on the most maybe misunderstood aspect of climate change?
Sure, I think it's really the duration of these events will be very varied. And not only the duration of the event, how long it takes to impact outcomes, but also different municipalities' ability to adjust to climate change. Jessica alluded to this a little bit in when she talked about New York. The corollary example to that is New Orleans, where post Hurricane Katrina, that city really never bounced back. And the reason for that is it had poor fiscal health, it had population outflows, et cetera. And it didn't have nearly as much wealth to be able to invest in infrastructure. So we think really a misunderstood aspect of climate change is really the duration of events and the tipping point in terms of asset values.
How about on the muni side? What do you think is most misunderstood?
Right now, I think from what I see from market pricing, longer duration risk isn't really priced in to muni bonds, except in very specific situations. And while some cities, even in the most climate exposed areas, are prepared to deal with climate risk, there are many, especially smaller ones, that don't have the wealth and don't have the tax base to mitigate that, that still have very, very strong credit profiles today. And bonds are pricing very tight. And I think the most misunderstood aspect is that we should see steeper yield curves for muni bonds in those regions that are more exposed. Right now, we don't see a steeper curve in areas with more risk, even though over time those areas will face extra stress, require more debt, and potentially see outmigration or tax-based declines.
Thanks, Justin. Alan, how about on the equity side? What do you think is most misunderstood?
From an investment perspective, I spent a decent amount of time talking about the mitigation opportunities. One of the things that continues to excite me about it and that I think is still misunderstood is that we're still in the first or second inning of decarbonization. By now, people recognize that solar and wind are plentiful, that these are viable technologies. I think few, though, recognize the degree to which companies and policy and regulation are all aligned on steady adoption of these technologies globally, and that you now have greater pockets of capital that are coming into the marketplace looking to solve for climate. And I tend not to bet against these types of this type of capital. The degree of intelligence that's being brought to bear to improve on decarbonization in the various forms that it will take. It won't just be solar and wind, but it will be a bevy of other types of technology. And I think that we're still relatively early in this, and that this is something that markets and investors continue to underappreciate.
Thanks, Alan. And I think from my perspective, what's most misunderstood is something that Woodwell taught us early on, which is a basic precept of climate science, and that is that emissions are cumulative. And on average, they exist for 100 years or so, depending on the type, but give it 100 on average. And so every day we are adding to that cumulative problem, if you think about it. And every day in the past has added to it. And so when you start to really think about the problem of a cumulative issue, it really starts to get inside your head about what needs to change a cumulative problem that gets worse essentially every day. And so I'm gonna end the session on this note. I do a lot of webcasts and calls, and people often say, what's the last thing you want to say? And I found I have no good wisdom on that. But I dreamt up the other day what the right thing to say at the end of all these meetings is, which is this: whatever you're going to do about climate change, do it faster. Thanks everybody for your time today. We appreciate it.